I want to turn now to that economic data that we got. Again, GDP in the first quarter falling by 4.8%. And that's likely not going to be the worst of it, right? Because we are continuing to see economic effects stretch into the second quarter because of coronavirus. We're joined now by Paul Gruenwald. He is S&P Global Ratings Global Chief Economist. Paul, it's good to see you again. Thanks for rejoining us. So
good to be back.
What do you make of this number? And what then is your extrapolation for what the economic growth is going to look like for the remainder of the year?
Right. Well, today's Q1 number for the U.S. was a sneak preview in a way. Growth fell by 4.8% annualized. We're looking for something much bigger in Q2. That should be a full quarter effect, 30% annualized decline, maybe more. What was informative today was the composition of the decline. It's very much along the lines we were expecting and very much along the lines of what we've seen already in China. Services took a bigger hit than manufacturers. And then within the consumer sector, the durables took a bigger hit than the non-durables. So all of the effects of social distancing on economic activity we've been following played out. But as I said, this is unfortunately just a sneak preview. We think the numbers are going to get much worse in Q2, not just here in the US, but globally.
Paul, let's look past COVID-19 as we get past, say, even the third quarter. We've larded up on debt. We have huge additions to the Fed's balance sheet. Why is that a potential drag in the future when it really hasn't manifested, or has it, in the past?
Right. Well, first of all, you look at the bond markets, right, and look at what the bond markets pricing debt. The 10-year yield's been around 0.6%. So there's a huge amount of appetite for risk-free debt right now. But you're right. The projections for the increase in debt to GDP here in the U.S. are between 15 and 20 percentage points. The Fed's balance sheet's going to be even higher than the $6 trillion right now. So as we get the recovery, and we will recover when we get the health all clear, I think we're going to need some clarity from the fiscal authorities and the central bank on how they're going to sort of unwind those extraordinary support. But right now, the market seems willing to digest it. But the debt levels were high to start this. They're going even higher as we go through it.
Hey, Paul, Rick Newman here. How high do you think the unemployment rate is going to go? When will it peak? And do you think we'll be feeling better about all this by the end of 2020?
Our U.S. economists see the U.S. Unemployment rate peaking at, I think it's 18 or 19% in May. The quarterly rate's a bit lower than that, but it's going to depend on the this interaction we've been talking about before between these policies to keep the labor market intact, PPP, and other things, and how firms and workers actually respond. That's not going to bounce back to 3.5% anytime soon. 3.5% is where we were when we started this for the unemployment rate. That's going to take several years, but we think the big impact's going to be in Q2. The peak's going to be in the high teens, and then a gradual decline after that. The speed of the recovery is going to really depend on how quickly the health restrictions get taken off and whether or not we get a vaccine. If that happens sooner, we get more of a V shape. If it happens slower, then we get a much more elongated recovery.
Paul, as we mentioned, you're chief global economist there. And so when you look around the globe at the countries that have reopened or are starting to reopen, is there anything that we can glean from what's happened with their economic trajectory, or is it even too soon to tell in, say, a place like China?
Right. We're looking at China. We're looking at South Korea and other places where we've got data. I think, first of all, as I mentioned earlier, the sort of trajectory of the decline is pretty clear. I think our takeaway so far is the rebuild has been slower. The health restrictions have been eased more slowly. The bounce back in productions have been a bit slower than we want. In China in particular, we've seen the big state enterprises and the well-funded firms bounce back quickly, but the more private part of the economy, the equivalent of our SME sector, has been slower to recover. They're still not up to pre-COVID capacity. So again, that suggests that things are going to take a bit longer, and that V scenario we're all hoping for, I think the likelihood of that's probably in the decline.
And so the FOMC statement later today is going to be central to get us through the next couple of quarters. Are you looking for anything specific? Is it on the Main Street lending facility, or something else to help support the economic survival to get to the next steps?
Right. I think the Fed at this point, and we've commented on this in the past, is doing the right thing, making sure that markets are functioning. We've got decent liquidity. We've got decent price discovery. The policy that's really going to set the stage and lay the foundation for the recovery is fiscal. And we've seen that enormous jump in jobless claims in the last 6 weeks. We've got the 26 million jobless claims. It took the global financial crisis 60 weeks to generate that same amount of jobless claims. So it's happening very quickly, but fiscal policy, keeping the labor market together, keeping the SME sector running, that's going to be the foundation for the recovery. So monetary policy is going to keep the financial plumbing moving, but it's going to be fiscal that's key for the recovery.
So, Paul, then the key question is there enough being done on the fiscal side? I mean, just to give an example, we saw today that a group of independent restaurants around the country banded together and is trying now to push for some more aid for that industry because, of course, the PPP loans are tied to hiring people back, which is something that many restaurants don't feel they can do right now. So what, if anything, do you think? I mean, fiscal has limits too, right? Or does it?
Well, the market seems willing to buy risk-free debt right now, so I don't want to say fiscal's limitless. That would be irresponsible, but there does seem to be an appetite for fiscal space. My reading and our reading is the will is there, but the execution's been a bit slow. You're right about the PPP. The loans get turned into grants, right, if they have 75% of the expenditure on payroll. But it seems to us that the funding getting to the most critical part of the SME sector has been slow to materialize. We've seen that big drop in jobs and jobless claims. Just to give you something to compare it with, in Germany, the experts there are forecasting a 0.5 percentage point increase in the unemployment rate, and we're talking in the U.S. about going from 3.5 to something like 18 or 19. So the Europeans seem to be in much better shape in keeping the SME sector going and the labor market together.
Well, let's hoping we learn some lessons from that here in the United States.
Absolutely.
Well, Paul Gruenwald is S&P Global Ratings Global Chief Economist. It's good to see you, Paul. Stay well, please.
Likewise, thanks.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.